Hi, everyone. Thank you for your time. We want to have a quick call analyzing the moves in credit markets given the recent events. So we'll spend around 10-15 minutes quickly to run through what is happening and what the opportunities are. The sell-off in credit markets has started with obviously an unwind in other markets, an unwind of trades on dollar yen, an unwind of carry trades in FX and equities, but it has propagated across markets, including credit. And it has been particularly focused on investment grade and on volatility. So here what we see is that essentially there's been between 1 and 6 standard deviation moves across markets with Japan obviously one of the leading movers, but also investment grade and high yield, and especially focusing on CDS indices and volatility, even in credit. So it's been a very sudden move, a very quick move, and a very technical move. What we want to discuss is whether there is more room to run, how long can it last, how deep can it go, and what the fundamentals are, and also what we're doing in this opportunity set. As you know, we have been discussing the likelihood of volatility in the second half for some time, even in our previous calls, and attributed to policy uncertainty, geopolitics, and obviously politics. And now this vol is happening. So we're here positioned in a relatively cautious way, taking advantage with the right instruments, taking advantage of this opportunity set. For the first time in a while, credit is attractive again. We are back to above average spreads. And this has particularly been the case for CDS index. So the hedging instruments have become very interesting, very sought after and wider. Overall, the market is still, in equity is still expensive. And overall, all-in yields are still interesting. But, credit spreads were close to record highs and they have normalized. The question is, will the move continue or will it stop here? Well, the most interesting move so far has been volatility. So volatility in FX, volatility in credit, and obviously the VIX yesterday went above 60 points. So the move in volatility, the August, summertime rush for hedging is a key opportunity here. We owned a lot of hedges, bought when vol was low, and we're taking advantage of that. We do think that eventually this very high level of volatility is the first opportunity that will fade. Then the second move is obviously the level of spread. The level of spread. So essentially, the level of spreads has widened. It's above average, and we do see that level of spreads has become attractive again. However, the concentration of the move has been in CDS indices and a few sectors, particularly Europe, particularly I would say financials, and not the whole market is attractive. So some areas of the market are attractive, but not everything. These areas, which are the most liquid, which are the most used hedging instruments, so CDS indices in the US, CDS indices in Europe, investment grade in particular, as well as vol, represent the quick opportunity right now. The most important opportunity right now. So essentially, we had a 2 to 6 standard deviation move in credit, driven by the unwind of carry trades and worries about growth. Now let's talk about fundamentals and let's talk about how this sell-off, how long can it last, and is it justified or is it technical only? First of all, I would say that with taking a step back, we're coming from 15 years of QE, 15 years of low rates, and 15 years of no vol, which is the blue area that you see right here. And since 2020, we're experiencing a period of higher vol events, more frequent vol events. They're also faster vol events because policymakers are much quicker in reacting to these events. So we obviously had COVID, but we also had, Russia in 2022. We had last year Credit Suisse SVB, and then we had the events of October. This year we had the French elections, and now we're having, the BOJ-driven unwind of the dollar yen carry trade, and also some weakness in the US economy. We do expect vol to continue to hit markets, but we also know that policymakers have ample room to cut from the current levels of rates. And the current levels of rates have particularly hurt small firms and the weakest part of the household spectrum. So they've not hurt companies, and that's also why we're still positive on the overall health of the market. So what is the path ahead? We clearly are not done with the sell-off. In our view, we will continue to retest the lows at least once, in our opinion. We do see that there is an unwind of carry trades that will continue, and the dollar yen carry trade is also linked to other carry trades across FX, across equities, and also across credit. A lot of the carry traders, whether they're macro hedge funds or credit hedge funds, they were levered long some forms of carry, including investment grade credit. Having said that, the fundamentals of credit markets remain relatively robust. So overall, our models do predict some probability of recession in the US, but this probability of recession has not gone up substantially. And this is because there is still strong health across corporate balance sheets and generally also consumers, even though the savings buffers have come down. Yes, there are weak spots. They are in the discretionary area, consumer discretionaries, restaurants, apparel, these kind of categories of spending, which we are seeing across the names that we cover, becoming weaker. However, we don't see that spreading to a fully fledged, broad-based recessionary environment. And I would say that companies in high yield, and also to some extent investment grade, but particularly in high yield, have already prepared to live with high interest costs. So they've already termed out their maturities, they've already refinanced. So fundamentals in the corporate space remain relatively solid, with default rates rising, but rising very, very gradually. And a lot of the names that encounter credit problems are typically able to refinance. It's essentially not a sudden stop. Even if there was a sudden stop in financial markets, there's names that are well refinanced, they don't need to access the bond market, and have liquidity typically for 6 months, 1 year or longer in the credit market. So essentially all the maturities from 2025 have been pushed, and even the 2026 maturities are very limited. So we do really need a heavy recession to see a bad default environment for credit. So valuations have gone back to above average. The default environment is gradually going up, but not very quickly. Finally, while there's a lot of focus on the current data, which is backward-looking data, and the jobs report, which was also affected by weather and monetary policy as a result of these actions. So the 2-3 Fed cuts that the Fed might do. There's a lot of focus on these topics. The focus is a little bit less important, a little bit less strong right now on elections and fiscal policy, which in our view remains the key driver of policy in the coming months. And we still continue to see a probability of a Trump victory around 60% rounded. It's a little lower than we had before. The vice president has done really well in recent debates, and Vice President Harris has gained a lot from the former probability, the probability that President Biden had formerly. So we've gone from an 80-20 scenario to a 60-40 scenario. In any case, a potential Trump victory would mean a strong fiscal policy, which in our view is not priced in, and would extend the cycle even longer. So we continue to see this as a soft patch in the economy. Corporate balance sheets are pretty strong, and maturities have been termed out. Companies are ready to fund at high levels of rates, where it comes from high rates or high spreads. The question is, what do we do now? How do we trade this environment? And as we said in the past, the one thing you don't want to do here is to be buy and hold. You don't want to be in a private credit fund locked at 10% for 5 years, because it will essentially prevent you from capturing all these opportunities, all these entry points across the cycle. And that's the maximum yield that you will be able to get, which is the yield that we see in liquid markets pretty much. So you don't want to be buy and hold. You also don't want to sell tails. You don't want to sell tail risk to a worsening economic cycle. And at the moment, that tail risk is, in our view, in investment grade. It's not in high yield. I mean, most commonly, yes, if you have defaults rising, high yield initially doesn't do very well, but it all depends on valuations. So the common knowledge says, defaults rise, there's a recession, high yield is a sell. But the reality is that actually high yield firms, some of them, especially in the single B area, they have a lot of support and spreads there are already wide. So the area of credit that we're worried about the most, apart from private credit, but the area of liquid credit that we're worried about the most is investment grade, and particularly triple Bs, and on the edge, double Bs as well, which are very crowded. Those are the areas where investors have been hiding from other parts of the market, and they trade very close to record tights. I mean, U.S. investment grade is now 60 basis points. It was at 50 basis points 2 weeks ago, but it's still pretty close to record tight. So we would not rush to buy investment grade or to buy, the high quality, quote unquote, credit, which is actually usually quite cyclical and is very crowded. There are actually some really nice shorts in that space. So we've been trading this quite actively. We have been buying protection across particularly US markets in June after the volatility around European markets and the price of protection went up a lot around French elections. As we discussed online, the French elections were a fade. In our view, our model was essentially predicting a very strong probability of a hung parliament. So we faded that risk. And the hung parliament scenario is what we had. However, what we saw is that the volatility around US markets, US credit markets, was very low. The cost of protection there was very low. So we shifted our protection there. And what we're starting to see now is, a deterioration focus on US credit markets, which have been a crowded long across investors, particularly investment grade, but also high yield. Let's not forget that US investment grade indices were at record high positioning, all-time high, until a few weeks ago. So we think that this can continue. Obviously, it's still a benign default environment and a fundamental environment, but as the unwind of the carry trades continues, which here we see according to our models will probably last, a few more days, maybe a few weeks. As the unwind continues, as volatility continues, these protection that we have accumulated allows us to buy high quality assets at good prices. And eventually, we will, at the extremes, we will want to have also some long delta position in the right assets, in the good quality assets. And what are these good quality assets? I mean, they are a combination of defensive sectors and companies that can withstand a low growth environment. So companies that not only are in the defensive sector, but also have support from shareholders or stakeholders, which is something we often see in credit, particularly on the European side, where shareholders have been contributing to delever firms, or sometimes even governments have been contributing to delever firms. And what we see here is that essentially there has been there's been a lot of buying of protection recently, particularly investment grade, and as consistent with the previous discussion. So I would say before opening up to questions that we are in a, as a recap of our views, we are in a soft patch for growth. We think the Fed will cut 2-3 times. We've been more on the 1-2 camp, but probably the recent data allows for 2-3 times. We don't see the necessity, the urgency for emergency cuts. We think that's completely overdone. We continue to see a strong consumer, except the bottom, which is hurt by high rates. The high rates environment has hurt in the front end the weakest borrowers. Well, the Fed has never really done QT aggressively. So the large borrowers and the large companies fund in the long end have been fine. They'll continue to be okay with lower long-term yields. But cuts will help the cuts in the front end will help the weakest part of the population. However, fiscal policy is also important. And post-elections, we're likely to see an expansion in fiscal policy, especially under Trump administration, if that happens. Generally speaking, we continue to see a technical unwind and shocks from the reverberations of a BOJ hike, and also from weaker growth in the US. They're going to hit, in our view, the areas that are most volatile. So US investment grade, most crowded, US investment grade, EM investment grade, and some areas of high yield. What you don't want to do here is buy and hold, because we continue to see an environment of vol into geopolitics and into political risks that we will see in the coming months. Ultimately, though, at the right levels, we see value in credit, particularly in areas which are unloved. So conversely, if we have the record longest positioning in US investment grade and to some extent almost record long in US high yield, the areas of European credit, there are areas which are very unloved and where investors continue to be short, and they have been left short after shorting European credit in French elections. So we're buying high quality assets. We're buying assets where other people are short, both in single names and in index, to maximize pain when the vol events will disappear and the markets will squeeze. And also in the second half of the year, we will see more likely special situations which are going to emerge in names that are weaker and will go and refinance. This is good for our shorts. Eventually, these names will be longs. However, right now we see that the available special situations opportunity set is still a bit expensive, both in developed and emerging markets. So things like Thames Water or Intrum or Altice, they're still sort of the less good apples that have fallen from the tree. We need to see some better apples falling from the tree and some better valuations to get into the special situations cycle. So we continue to see a good trading environment in the liquid and the performing market, driven by rates volatility, policy volatility, geopolitics. We are relatively well positioned for this, a lot of dry powder protection. At some point, we're monetizing that. And we see the better areas of performing credit in Europe. Later on in the cycle, we might see more special situations, and we're ramping up that part of the strategy. But for now, we are very happy to stay in the liquid space and trade in this market. And with that, I'm going to open up to any questions from our colleagues.
Perfect. Thanks, Alberto. So if I can, we've got 3 questions that have come in, and if I can summarize them, the first one effectively is in the last week, we've seen IG spreads basically underperform high yield spreads. We've seen Europe outperform the US. Do you essentially see this continuing?
So look, the France and the Italy deficits are going to be a problem at some point later in the year. So if we think about Europe, we need to divide between investment grade and high yield. And typically, even within Europe, which is an unloved market, investment grade has been more crowded. So if we think about what happens when Japanese investors have positive yields in Japan, what they have been buying in the past, it's mostly, government bonds, investment grade, long dated maturities, and things that have 100 bips of spread or around 50 to 100 bips of spread, so OAT and BTP. So I would say that the potential lower demand for credit from Japanese investors and generally the unwind of this carry trade hurts a little bit the investment grade market, not in terms of defaults or downgrades, just in terms of putting a slightly higher ceiling, higher floor where spreads are in investment grade. Having said that, if we look at the high yield market and we think about all the issuers in the European high yield space, we have seen very proactive refinancing. Companies that, even with high leverage, have been able to delever to get into longer transactions. And so this leaves the short-dated risk of defaults as something that's relatively limited. We don't like to buy the worst names, for sure. We're going to see some defaults. So I think in this environment, you want to be the second taker of losses. You want to be in a mezzanine area of the capital structure. You don't want to be in the most junior part, in the worst names. You don't want to be in triple Cs. You want to be in solid single Bs. You also don't want to be in the areas that are very, very crowded in investment grade because they don't yield much. And I think the gains that investment grade has obtained so far, which are in total return, also thanks to duration. I mean, that part, has been quite well priced. We have a lot of cuts priced. I mean, we were not a fan of duration. Maybe, we don't always get every trade right, but we were not short. We didn't position very long duration, but I think now the trade has gone a long way, both in the front end and also in the long end. So if you had investment grade credit and you made a lot of returns from that duration, I mean, you can now move to things that have higher spread and don't lose if rates re-widen.
Perfect. The second question is essentially, which are some of the IG or crossover names or sectors which basically can still widen further, and what have you been adding in the last few days?
Yeah, so I think that's a question for you, but as well. But I think so. I'll take some of that. I think that around France, there was a lot of panic around banks and also some industrials. And even if Le Pen had won, does not mean that the French banks would have defaulted or the Italian or Spanish banks. So that was a very interesting opportunity. And also some of the French industrial companies widened as well. It's not justified. You can see pressures on the sovereign, but not on firms, especially in a government that wants to spend more, and that spending goes to the private sector. So we've been adding there, but we also took profits after the elections. Right now, I would say that there are three things to look at. The first is volatility. So when you have a VIX at 60% or 70 to 80% levels of credit volatility, you're essentially starting to price a COVID type event. So the levels of volatility were essentially the highest since COVID. So that level of uncertainty priced in the options market has been really interesting. And to some extent, we had been long option protection. We have taken some off, and particularly in the investment grade space. Why is it interesting? Well, because we don't think that what's happening in Japan can spill over to banks. It can spill over to asset managers, but banks are very protected. Banks were very solid even after the Credit Suisse event. And if anything is affected by the asset management and the levered carry trade world, that would be US banks, not so much European banks. So a commercial bank in Europe is a lot more affected by interest rates and fundamentals. And even the banks that are weak, are actually killing it. If you think at Monte Paschi results today, for example, was very positive. So actually the smaller banks, the mid-tier banks, and the European banks are more isolated from the events of Japan. So we added that. We also added names that are supported by shareholders, names that are deleveraging, names that have positive catalysts, and typically names that the sell side and so the street has been short across telecoms, across industrials. Let's not forget that, again, a lot of market participants remain short bias to Europe. So that's essentially where we've been adding. First, in volatility by unwinding some of the protections. Second, in CDS indices, and then CDS single names, which are the hedging instruments that other people are using. And ultimately in cash bonds, but only in areas where we see that supply of those bonds is limited, because ultimately the first legs, the fastest moving legs of these sell-offs tend to be the hedging instruments rather than the underlying.
Perfect. And then maybe as a final question, which you in some ways answered right at the start, is, we're now talking about over 100 basis points in cuts in the front end. There's even some discussions about an emergency intra-meeting cut of 50 basis points. How is it needed and how valid is that?
I mean, look, obviously the data of the coming weeks will tell us more. We have jobless claims, we have CPI and more data points. But what we see right now in our real-time indicators of the economy of credit markets is that things are slowing, but they are still orderly. And if the Fed cuts 2 or 3 times this year, the soft landing scenario is still here. It's not an emergency scenario. It's not a financial crisis scenario. Obviously, we don't know what will happen over the coming days. And the data points, but everything that we see right now is consistent with a technical unwind of crowded positions. A lot of people were long carry. We heard and we read on sell side reports, this is the summer of carry a few weeks ago. Spreads were at record lows. We have a healthy repricing. And what I would say that this is something we're quite confident about is that even with more volatility, this will not create a default environment. Even if we have 3 months of volatility, 3 months of high spreads, these companies have already lived with high rates and high spreads for some time. So the transmission mechanism of volatile markets and risk premium to the credit market and also the banking system is a lot more robust. We're not in a scenario where banks are very spread sensitive, where banks own a lot of sovereign, or in a scenario where corporates, investment grade and high yield, have very front-loaded maturity. So I think that we're looking obviously at a few cuts, 2-3 cuts for the Fed, but we're not in a deep situation where companies are going to default. And as a result, when excess tail risk is priced at the extreme, this is a welcome opportunity to buy good quality assets. Thank you so much for your time. We hope this was an interesting update, even if short. And please do feel free to come back to us with any email or messages or questions to ourselves or to our colleague Hopewell Wood Happy to follow up. Thank you and enjoy your break during the summer.